Ladies and gentlemen, please take your seats. Our event is about to begin.
Got it that time. Was it loud enough? Yeah, definitely.
That was good.
Keep that same old feeling. Keep that same old feeling. Keep that same old feeling.
Ladies and gentlemen, please take your seats. Our program is about to begin.
Fade out the mic. Fade the mic first.
Please take your seats. The event is about to begin. We have no planned fire alarm tests today. If the alarm sounds, please make your way to the nearest exit. Members of the Bloomberg security team will be on hand to guide you. Please take a moment to locate your nearest exit. As a courtesy to our speakers, we kindly ask that you switch your phones to silent. Thank you.
Ladies and gentlemen, please welcome Bloomberg's Naira Chahich to the stage.
Go to the title slide, then mic live. I think you guys were supposed to clap there. It's fine, I won't take it. Good evening, everyone. And on behalf of all my colleagues at Bloomberg, really delighted to welcome you to this event, Futures Forward, the Trader's Guide to Market Psychology and Investing. I mean, what a treat for a Tuesday. Look how they've done the room up. Does anyone else feel underdressed? I almost do a little. But I want to extend a warm welcome also to everyone joining us on our live stream. That's bloomberg.com/live stream. So you're all being watched. Be on your best behavior. Special thanks to our sponsors for this event as well, CME Group. We really hope that you've gotten to network with some of your colleagues. Perhaps you've met some new friends and potential colleagues tonight. And do feel free, if any of your conversations were cut short, to continue those conversations after the event. We'll have drinks and canapes just outside. So this evening, we're going to hear from key players and top executives in the investment industry on how investors like yourself can look deeper at your trading mentality and your risk-taking, and also how you can best use futures vehicles to make the most of today's market, and how technology and intelligent research is changing the way we invest. It's kind of a good week to do an event like this because, I mean, Bloomberg certainly has written a number of stories about how it's one of the biggest weeks for the global economy this year. You might have all been aware of a little meeting happening in Singapore earlier this morning. And of course, we had the G7 summit on the weekend, 3 big central banks meeting as well. But yet, volatility has been pretty suppressed, certainly if you look at the VIX. So we'll hear more about how volatility and many other elements of the trading environment feed into using futures and other derivatives in your portfolio. Now, as a reminder, everything said on stage is on the record, so feel free to tweet your comments, observations, and photos using the hashtag #FuturesForward. You can also follow our Twitter feed via @Bloomberg Live and also tweet @CME Active Trader. But now I'd like to bring a special guest to the stage. Please join me in giving a really warm welcome. That's it, you've got to clap, to Julie Winkler. She's the Chief Commercial Officer at CME Group. Julie.
So thank you. I'm Julie Winkler. I'm the Chief Commercial Officer of CME Group, and I'm really excited to be here with you this evening and teaming up with Bloomberg to really help educate traders like yourself about the benefits of futures. Our goal is that you walk away from tonight, from this event, even more informed on futures, both how you can use them to hedge your portfolio or also identify new trading opportunities. Our guest speakers tonight will go into a lot of detail about our products later in the program, but I wanted to just give you a few insights and some of the general trends that we have seen at CME Group among this particular product segment. Retail futures trading is growing, and here's really why. Because over the last few years, we believe there's kind of 4 key reasons that are attracting retail traders like yourself to our products. And they are using these products to express an opinion in the market and hedge their portfolio. The first of those is greater market access. So if we go back 15 years ago, many of the online brokerage firms that exist there then and even today simply didn't offer access to futures like they do today. That is definitely not the case as we sit here in 2018, so the access is there. The second one is access to educational content, and this is a key part of any type of retail trader and their education process. Getting started with trading futures really has never been easier. There is some great content out there, often provided by a lot of these online brokerage firms, but also available on our website at cmegroup.com. The third is really, we are certainly in a period of heightened geopolitical uncertainty, and everybody has a need to better manage the risk within their portfolio. So if you look back at key events, you look at Italy, you look at the Brexit vote, you look at the US presidential elections, those were key market events. And what we found was millions of trades were taking place in CME Group products because we were open for business 24 hours a day, and we had the available products that people could use to express their interest in the market at that particular point in time. And last but not least is futures are very cost effective. And so if you think about them really as an investment tool for individual traders looking to take advantage of them, you could take an entire futures contract, right, and replicate a basket of individual stocks at a much cheaper price, less margin to post, and certainly tying up a lot less capital. And those are really kind of those general trends that we're seeing. We're excited, again, about being able to launch into a lot of those product details and really have a dialogue with all of you tonight to learn more about how we could better serve your needs. So after the program, we will have a number of representatives from CME Group that will be around to answer your questions. Also, in the packet that you have on your table is more information on some of those educational resources that I talked about. So some key things there on our website. We offer a trading simulator and also things like daily market commentary. So you can get very direct, timely information on what's going to move the markets that particular day and many, many more things. So we invite you to check that out at cmegroup.com. And really, most of all, just thank you for being here. It's a pleasure to work with Bloomberg and to see the room filled up so that we can kick this event off. So thank you very much.
Thank you so much, Julie, and thanks again to CME Group for sponsoring tonight's event. Now I'd like to introduce our keynote speaker for tonight's event. He's considered an expert on the mental game of trading. Dr. Doug Hirschhorn has applied the techniques that he learned in pursuing a PhD in sports psychology and has worked for decades to help individuals and teams at global trading firms and hedge funds to achieve excellence in their performance. Please welcome Dr. Doug to the stage.
Thank you. Thanks. Thank you very much. What % of trading is mental? Anybody? 90? 90? No one's saying 100. Please, there's not 100 of them, right? So, okay, good. It's not 100%. 90% mental. Does anybody think it's less than that? What's the lowest you think? What's the lowest number out there? 70%? Anybody lower than 70? 50%? Anybody think it's 50% mental? It's a reasonable expectation. Some people might think that. 50% mental? 50%? Here's the compelling question I want to ask you about today. If it's 90% mental, if it's 70% mental, if it's even 50% mental, what % of your time and resources do you spend working on your mental game? Compelling question. Because the differentiation of mediocrity and greatness in trading is actually not that complex of a concept. I'm going to share with you some of the things that I've learned over the years in working with the best of the best, helping them sharpen their game. My background. I have a PhD in psychology with a specialization in sports psychology. People ask me all the time, why do I bother clarifying that? I'll make it very quick and simple for you. Sir, what's your name? Constantine? Nice to meet you. I'm Doug. Would you like to hear about my personal problems? You cold-hearted person. I make a joke of it because I decided a long time ago to not be a therapist, to not be a counseling psychologist. I wanted to focus on performance, improving performance. Initially, it started with athletes. Because I was a baseball player. I played Division I baseball in college. I was a catcher. Catcher in baseball is a unique position if you're not familiar with the sport. It's the one position on the field that you see everything unfold in front of you. Everything. It's the only position you see that. Other sports, you get a perspective of half the game or part of the game. As a catcher, you actually see the whole game. And you can control the pace of the game. Strategy, thinking. Herniated disc in my lower back. That was the end of baseball for me. Had surgery. Went to go work on the trading floors in Chicago, actually at the Chicago Mercantile Exchange. That's where my career started. And I thought to myself, this is the greatest job in the world. I am surrounded by like-minded people, other competitive athletes, other individuals who wanted to compete, who were used to competing. Except I hated it. On the trading floor, it actually was all about the money. That's all that mattered. If the person next to you fell down and dropped, all you cared about was, does he or she have a better spot in the pit? And if so, then you take that spot. I'm a team-minded athlete. I have a higher level of empathy, and I realized I don't really love this. Fortunately, a herniated disc in my back, I re-injured my back, and that was the end of that. Doctor said basically, find a way to make a living sitting down, because you can't do this anymore. No problem, doc. I hate what I'm doing anyway. Love baseball. I'll go be poor and happy the rest of my life. My big plan was to be a baseball coach. My thought process was, I love baseball. Money could be secondary, if at all. So then I went back to school to study sports psychology. Now, traditional sports psychology, anybody familiar with sports psychology? Concepts of it? A lot of it is related, if you play golf or tennis, I know they use some sports psychologists for the rugby teams. It's about visualization. It's about focusing under pressure, about goal setting, but a lot of it's about relaxation strategies. You teach athletes, the assumption is that you have the skill set, right? That's the assumption. And you teach them how to focus better under pressure, so when the game is on the line, they perform at the top of their game. Well, I got a job offer to go in-house with a hedge fund, to be their performance trading coach. The job didn't exist. They just liked the idea of my sports psychology background and come on board. And our traders, we have 1,000 of them, 1,000 prop traders. They're athletes. They'll relate to you very well. Okay, that made sense. After the first year, the feedback I got from the traders, we're still losing money. We just feel better about it now. And that's when I realized I can't make a living doing that. And so I started to study behavioral finance. I started to study cognitive biases. I started to figure out why is it that smart people, talented, skilled people, when it comes to money and decision making with the trading process, they lose their discipline. And how many times as a trader have you said to yourself, if I had only stuck to my game plan, or if I just trusted myself, or if I hadn't listened to the other person's opinions, and just focus on the inside. You're going to laugh today. I'm entertaining at the very least. But you'll also learn, and that's very important to me. I want you to walk out of here with something, and it's going to be more than one thing, that you actually can put into place immediately on your next trade. I'm going to show you process. I'm going to show you things and techniques and strategies that I have used and worked with over the past 20 years, and I know they work. And in your bags is my coaching manual. It's a 60-page book. Each chapter is 3 pages. There's no case studies. It's, this is going to happen. Here's how to solve it. This is what to do. This is how to think about it. I'm not here to tell you what to trade or how to trade. I'm here to help you take whatever your process is and make it the best it can be by showing you some of the things that I've used that I know work and some of the things that I've used over the years that I know don't work. And I'll tell you what doesn't work. Thinking happy thoughts. That doesn't work. Hoping, wishing, and praying. That doesn't work either, by the way. Process. Focusing on the process. This will be highly interactive. I may call on you. If you don't want me to call on you, please just stare down. I won't get offended. Just look down at your notes or whatever it is. Stare at your feet. But if you're staring at me, you're free game. Because I can't read minds. Right? I'm looking. You might be daydreaming. I'll say, sorry, didn't mean to embarrass you. I'll move on to the next person. Right? But just those are my parameters. I want you to learn. Interacting. Learning from each other. And learning from the knowledge that I can give you today. What's the most important skill in great trading? What's that? The third one. Controlling your emotions. Anybody else? Not losing money. Okay, risk management. Number 4, establishing game plans and sticking to them. What's that? Number 2, risk management. We talked about that, discipline. All of them. Good. I like the way you're thinking, because this is the single most important skill for great trading. That one word. What's that word? Edge. That's it. That one word. That is the single most important skill for great trading. And just so we're clear, I'm not talking about black edge. I'm not talking about that illegal stuff. What I am talking about is 2 things. The first one is called probability-weighted decision making. It's a lot bigger word than the complexity of it. Trust me, I'll walk you through it. And you're going to learn how to do it. You already do it already. I'm going to show you how to apply it to your trading and thought process. And the second one is having a consistent trading process. Let's start with the first one. Probability-weighted decision making. You ever been to a casino? Good. Familiar with roulette? We know the game? I'm going to use it as an example to help you prime the thinking process along this. So in roulette, how many numbers are on the wheel? European roulette. You know, there's a difference between European roulette and American roulette. Does anybody know there's a difference? We'll talk about that in a second, right? How many numbers are on the wheel? Who said? 57 numbers. I'm going to show you in a second. How many numbers do we know in the wheel? Anybody? 34. How many are red? How many are black? Half and half, right? It's about half and half, though, right? Good. Everybody, about half and half. How many even? How many odd? It's about half and half. This is actually a remarkable thing. That is a roulette wheel, European roulette wheel. The difference between the European roulette wheel and the American roulette wheel is European roulette wheel has 1 green 0. The American roulette wheel has 2 of those. They have a green 0, which is a number, and then they have a green 00, which I'm pretty sure is not a number that exists, but nonetheless, it's on the wheel. Interesting. But what's odd about that is it's green. Casinos are very smart people. I'm going to show you what they do to us, and let's see if we can learn from them and think about how to apply that to our trading process. That's what the board looks like. Now, if you notice, these are actually, their whole methodology is based on not only probabilities, but based on making things socially uncomfortable for you. So if you're at the roulette wheel and I'm standing over here, and if I wanted to bet on green 0, I actually have to reach across the table or talk to the person next to me to put my, it's not an easy thing to do. If you've ever experienced that, try it. And if you haven't experienced it, I encourage you to go to one of the, just as a learning experience. I'm not encouraging you to become a degenerate gambler. What I am encouraging you to do, though, is to think and understand what exists with these things. And that's the odds. Now, my friend over here, what was your name? Yes. Fabio? Fabio said it's about half red, half black. You're right. It feels like it's 50-50. But there's actually a mathematical element in here. Your actual percent chance of winning is actually only 47%, not 50-50. That doesn't sound like a big difference, does it? 47 to 50%. That's a 2.7 edge. That casino only wants that game played forever because they are guaranteed to make 2.7%. That's why they build buildings in the desert in the United States. That's why they build them on islands in Macau. It's because of that simple concept. The games are mathematically in their advantage and our disadvantage. And you know what they do? They do other stuff. They give us alcohol. They make the chips the same size. The floor's all messed up. You ever been to Vegas? It's like torture land, okay? Sensories getting hit everywhere. There are people half-dressed walking around. There's no windows. You can't get out of the place. It's all intentional. You go out for a late night, come home at 6 in the morning, and guess what? Roulette's still being played. And you think, do these people go to sleep? The answer is no, they don't, because it's a mathematical game. What's your name? What's your lucky number? Doesn't really matter, does it? I'm not a mean guy. I'm just being direct. I want you to learn. Your lucky number is irrelevant in that game because it's just as likely to come up as green 0 as, what's your lucky number? Yes. 7. Lucky number 7. Probability is the same. And they throw another element that really is psychological cruelty. It's called the Cyclops. You know what the Cyclops is? This is actually mean. That's the Cyclops. It's actually this thing, a digital board next to the roulette wheel that shows you the past 10, 15, 20 spins. So when you start seeing a pattern of reds come up that many times, is your next bet going to be on red or black? No, one next to you. Yeah, red or black? Red. Red. Anybody betting on black? Black. You're all wrong. That's the beauty of this game. But if you're betting red, you think red's hot. Or you're saying to yourself, you're caught by the bottom number there, aren't you? You're saying, well, red's only come up 41% of the time today. So it's what? Due. That's the mental game. You want to approach this like a trader without the emotions, without the influence of your biases and opinions about your lucky number, was it 26? And your lucky number 7. You want to come to it with the idea of how to think in probabilities. Then all you need to know is that if you play roulette, you're playing for recreation, not as a way to earn a living. I want you to hold that in your head, because what I find over and over again is you trade sometimes for recreation. And I'm going to show you how. And I'm going to show you why. And all I ask you to do is stop doing it. Why do you trade? To try to make some money? Go to the casino. You can try to make some money. Why do you trade, sir? To try to make money or to make money? Let's do that. Does anybody here trade to make money? Please raise your hand. I didn't ask if you actually do make money. I want to know if you trade to make money. Is that the reason why? Is anybody here trading to make friends? You are. At least you're honest. I trade to make money. If you trade, you know why casinos exist? They exist to make money. That's why they exist. They figured out the formula, and I want you to think about it and how you can figure it out for yourself. So think like a casino means using probability-weighted decision-making process to help you make objective decisions rather than the emotionally driven ones. Does anyone have a pound on them? Pound coin? Someone in the room? Yep. You do? Awesome. Come on up here. I'm Doug.
I know in a seat.
Hi.
Very much. Okay.
What's your name?
Ed.
Ed, nice to meet you. Ed, I got a seat for you right there. Ed's going to help us out today. Thank you, Ed. Now, I'm going to poke fun at everybody, including Ed, but it's just because I want you to learn. So work with me on this, and we're going to learn about how to think in probabilities on a real example with Ed as our helper. All right, Ed, so you have a pound? I have a pound. This is not a magic trick, okay? If you can't see, stand up. It's well worth it. Trust me, crowd the stage. You're going to love this one. You validate they're both pounds. Real coins? And can you look at there's heads and tails to them?
Sure is.
Yep. All right. £50. You validate that's heads and tails, or two sides of a different coin. Great, you hold that one. Here's the game. You hold it, you flip it, you call heads or tails in the air. If you get it right, I'll give you my £1. You get it wrong, you give me your pound. Would you like to play that game?
I would.
Raise your hand if you're playing that game. Only 3 of you are playing that game? You're playing the game? How about this? Raise your hand if you're thinking to yourself, I'd play that game, it's just a pound, who cares, it's not a big deal. Raise your hand if it's a very honest answer. Great. That's the worst answer in the world. And I'm going to show you why that's the worst answer. But it's a very common one. Right now, write down on a piece of paper what's a lot of money to spend on dinner for 2 people. Go ahead, write it down. A lot of money to spend on dinner for 2 people. Don't show anybody. Quickly jot it down. I don't have time to ask everybody. We'll get back to you in a second, Ed. Don't you worry. We ready? Now I have an anchoring problem. I'm going to ask someone how much they put down. If that person put a very high number, the person with a low number is going to feel awkward. If you put a low number and I call on you, you're going to feel awkward. But I got to take the risk here because I can't collect everybody's how much they spent for dinner. So, sir, how much what'd you put down? 600 pounds. What are you doing tonight? What'd you put down? Yeah. Huh? Oh, he put 6. What'd you put? 120, we're getting there. What'd you put? Yeah. 100 pounds. Anybody less than 100 pounds? Oh, there we go. What'd you put down? 60 pounds. Anybody less than 60? Good. So here's what I've assessed from that sample size. You're broke, and you're the richest guy in the room. Is that a fair assessment? I have no idea. It's personal value systems. My point is the market doesn't know your value system. You just made a decision based on, well, a pound is not a big deal to me. By that same logic, if I said it's 100 pounds versus 100 pounds, you would probably say, I wouldn't play it because it's what? Too much money. That's not the question I'm asking. This is a math question. It's a math question. You gonna play that game?
Yes, I am.
Anybody not playing that game? You're being difficult in the back. You wouldn't play the game either? Why not? He's one of them. Let me know when you're done. I'll keep on going. You good? All right. 5p. Same game. You flip it, you call it heads or tails. You get it right, you get my 1 pound 5. You get it wrong, I get your pound. Would you play that game? Of course you would. You're degenerate. You'd have played it the first time. Would you play this game? Ah, now we have a learning point. Because I'm sure he's a very smart man. He just basically told me that he would not play this game. What is the mathematical advantage you have in this game? It's a math question. 50-50 is the probability. What's the payout? 5p. Half the time, that's what percent? 5p represents a 5% return, and half the time, because you're going to get it right half and wrong half, is a 2.5% return. Did I remind you that they build buildings in the desert because of this concept? Your answer to me should only be, I want to play that forever. What did you get distracted by? The amount. It's just 5p. What did you not think about? The percentages. By definition, is this a small edge or a big edge? Small, right? This would be, Ed, do you have any edge here? No? We're going to make you a great trader before the end of the night. Don't you worry about that. These are not complicated concepts. I'm just getting you to slow the thinking down. No edge, no bet. Small edge, small bet. This is 420 pounds. Keep your hands in your pocket, please. Would you play the game now? Of course you would, because you're a degenerate the first time you're playing the game when it's even. Why not? Now you've got real money on the table in your mind, so you're thinking to yourself, have I changed anything about the probabilities of this game? No. It's still a 50-50 game. Do you know what 45 to 55% is? Do you know what that number is? Tattoo it to your body if you want to make money in trading. Because 45 to 55% is the average winning percentage of discretionary traders. That's not my opinion. That's what the risk managers and the data over 2 decades polls 45 to 55%. So how do the elite traders make so much money trading? Is it because they're right more often? No. It's because when they have a lot of edge, they place a big bet. When they have a small edge, they place a small bet. And when they have no edge, they do what, Ed? They don't bet. And that simple concept right there is a game changer for your trading. All you have to do is have the discipline to think that way to improve your performance. Pop quiz time. You ready, Ed? You ready?
Yep.
This is a big moment for you. If you had a 95% chance to win a bet, would you place that bet?
Yes.
Let's try that again. Okay, how about this? When you win, I'll give you £1 million, and you lose, you give me 10 million pounds.
No.
Ah, so what did he forget to think about? He thought about the 95%, like some of you did in the room. If you have a 2% chance to win in a game, would you play that game? Slow your thinking down.
Potentially.
Ha! Potentially, I've just converted this man from a person who might never make money trading to someone who can actually make a substantial amount of money trading. What else do you need to know?
The reward.
Thank you. How much am I going to make if I'm right? How much do I lose if I'm wrong? And at the end of the day, Ed, what I want you to understand is that if you have no edge, you don't make a trade. If you do have a small edge, you make a small bet. And if you have a large edge, you make a large bet. So today, Would you say that you learned how to think about edge? I agree with you. You found your edge. Thank you very much. Round of applause for Ed, please. Thank you. You can take your pound. Thanks. Not a complex concept. Not a difficult way of thinking. Simple. Simple thought process. Slow the thinking down. Stop getting distracted by the probabilities and ask yourself about the whole equation. The second piece of the puzzle, consistent trading process. I'm going to show you a template that I've designed over the years to help people that have the skill set focus their process, to put a framework in place for them so they can be consistent in their trading process. It's not just understanding the probabilities and understanding when I should place a bet and when I shouldn't place a bet, but you also have to understand how does that lay into your specific, unique approach to trading, whether it's systematic, whether it's purely discretionary, whether it's technical, whether it's fundamental. It doesn't matter to me. I have seen people make money with a variety of approaches. The important thing is that you have an approach and you consistently stick to it. So the first part before you enter the trade, you want to list the reasons you want to be in the trade. Does anybody here do that? Write down the reasons why you're putting a trade on. I see heads going like this. I'll go back to the first question. Why are you trading? Entertainment or to make money? If it's to make money, then this is a job. This is a real job. It looks like it's something easy to do because you push a button and you get excited and energized. But if you actually want to make money, you have to treat it like you would a job. And that means sticking to a process and developing a process. And then when you put the trade on, you've got to calibrate it. Score how important each of those items are. How relevant is this piece of information or this data point that I look at to doing the trade? Then the trade moves. You establish conviction and sizing through some formula. I'm going to show you the template. There's a little card in your books, actually, that's printed with this exact template, which I'll show in a second. And then at time 2, you rescore. Time 2 could be a day later, a week later, a month later. It doesn't matter. But the point is you're rescoring. How important was the reason when I got in the trade? How important is the reason now? Looking at the trade as if you're not in the trade. Because what happens is, once you're in the trade, you start to think emotionally. Does the market know your positions? Feels like it, though. Does the market know your P&L? Feels like it, though. You have to objectify the process. I promise you, the market is not out to get you. I have never seen your portfolio on anyone's screen. I'm sure it's only on your screen at home. The market is not trying to destroy your career or your lives. And it doesn't know your stop levels and hit your stops and then bounce off it. It feels like it happens. But that's because you're taking it personal. And then you reestablish your conviction and sizing in the trade. That's what the template looks like. So go ahead, pull the card out of your books, please. This will be a learning moment. My coaching manual, I don't publish that book publicly. The reason why is because I wanted to be able to give this information to people that were professional traders, to people that actually wanted to learn. Rather than me just talking about all the stuff you've already heard about psychology and trading, and I wanted to go to the next level of giving you actionable things. This is the template. This is a template I developed for a long-short commodities trader, discretionary trader, happened to be London-based, managing a multi-billion-dollar portfolio. The concept problem was that the numbers got so big it was freaking him out. The P&L swings were so big it was freaking him out because he's human. So I got him to break it down to pieces. Daily reminders on the top. These are his rules. Trade to make money, not to be right. The path is more important than the idea. Think in terms of probabilities. Basis points or percentages rather than dollars. Anybody here thinking their P&L in terms of dollars? Stop doing that. When you do that, it turns into things called tangifying. It turns into a car, a mortgage, a house, kids' camp, whatever it is. Percentages, probabilities. Trading is a game of probabilities, not perfection. It's 45 to 55%. You're not trying to be right all the time. You're trying to know when you have mathematical edge and when you don't, and then place bigger bets when you do and smaller bets when you don't. And is my current size in line with my conviction level? Is my current size in line with my conviction level? Time 1. There's the trade, long XYZ. Reasons A through J in the trade. How important is the reason today? On a scale of 1, not very important, to 5, very important. How important is that today? That's the calibration. Sum of parts. You're breaking it down piece by piece. It's hard enough to make money trading. But if you're battling yourself, it's even harder. Is this fun? What do you think? What's your name? Yeah, did I catch you spaced out? Deepak? Do you think this is fun? Do you think this would be fun to do? Of course not. This is not fun. This is not enjoyable. This is not. If you want to have fun, go to a casino. If you want to be smart, write a book. Do you want to make money? Do this. The people that make money trading aren't any smarter than you. They don't have access to better resources or information or computers. That's not the differentiation. It's just not anymore. They're just more disciplined. They just have a process that they follow religiously. And it's hard. And they hire me to hold them accountable. And I literally look at them and I say, I don't understand why you want to do this. You have 3 wives, 6 kids. They all hate you. You have a jet, an island. What's the point? They look at me, and the answer I get all the time is, not about the money. It's not about the money. It's about the game. It's about winning. It's about the discipline. You think while you're trading is to make money. The reality is that you're doing it for other reasons. And they're not healthy reasons. But you can change that. Very simply change that. Putting process in place and being willing to commit. Has anybody tried to lose weight or quit smoking? Anybody in the room has tried those things? Is it easy to do? No. Has anybody been successful in doing it? That same thought process, I kid you not, that same psychological barrier is the same thing I'm talking about here. The only difference is you quit smoking, maybe you get to live longer. You trade with process, you get to make more money. Not to mention the psychological impact of you're probably going to be more pleasant to be around, and you're going to be a happier person in general and feel more successful. All those other cascading things come along with it. It amazes me. When I work with traders at all levels, they want they ask for, like, what's the magic formula, secret whatever, what do I not know? You know everything there is to know. What 3 things can any market do? What's your name? Yeah. William, what 3 things can any market do? Wow, you must have a PhD in astrophysics. Maybe you do. Did you hear what he said? What 3 things can it do? What's your name? Yeah. What 3 things can a market do? Are you positive? That's the game. Up, down, sideways. You make it more complicated. You make it more difficult, more challenging. Once you've calibrated the score, you get a total points number. I just made it a 1 to 5 scale. It doesn't matter what the scale is. The point is that there's a scale, and the total points there is 31. That 31 means nothing. It's just a relative marker is all it is, because at time 2, we're going to add up the numbers again and come up with another value system based on those numbers. It's 31. And then on the top there, I have a point range. If it's between 30 and 40 points, then it ranks as somewhere between an A and B conviction, and I should have 4 risk units on. Do you see? I didn't mention the word dollar, money, P&L. None of that stuff came in here. Risk units. I should have 4 risk units on, whatever that's defined by your parameter of how much capital you are. It doesn't matter to me how you figure that out. But 4 risk units are more than 1 risk unit. That's all you need to know. And it's less than 5 and more than 3. That's all you need to know. With that point system, I have 4. Now the problem is You only have 2.5 risk units on because you're trading a little scared because you just got mopped up and you're a little on your heels, which is fine. That's normal. But I want you to face the reality. You need to increase it 60%. Doesn't mean you're going to, because you might have very good reasons based on your P&L, based on your loss limits, based on your stop levels. I'm not judging any of that. But I want you to have the conversation with yourself. I want you to lay it out objectively. That's time period 1. You see where it goes? Time period 2? Time period 2, we recalibrate those data points. Maybe the points go up to 40. Because you're looking at the trade. Are these reasons, how important are they right now? Not when I put the trade on. Problem with game plans, did you say game plans at the beginning that they're important? I think you did. No? Someone did. Anyway, the problem with game plans is you put them on at the beginning of the trade. That's the good part and the bad part. The good part is you put it on the beginning of the trade. The bad part is then the world starts happening. And things start happening. So then you start to wonder, do I change my game plan, stick to my game plan? You get in that kind of foggy area. Market doesn't know where you're long or short from, does it? Of course not. You're making decisions based on where you are, and you're probably trading your P&L, meaning you're staring at your P&L and saying, wow, that's a lot of money. Well, not for a 600-pound dude over there, but yeah, most people, that's like, wow, that's a lot of money. I got to get out of the trade. Well, I'm down a lot of money, as opposed to looking at it objectively. Sum of parts approach. The combination of probability-weighted decision-making and consistent trading process, what it does is it sets the foundation for a stable and repeatable and consistent returns. And that's what you want, stable, repeatable, and consistent returns, because it allows you to always know why you're in a trade. The current reason, not why you did it before, but why you're in it right now. It allows you to quantify your level of conviction for placing a bet, and systematically determine the size of your bets. Systematically. It's no longer about your comfort zone. It's about the sum of the parts say I should be this big. And then you need to stretch your comfort zone. And it helps you dramatically improve your discipline around managing losses, because you're looking at it at independent points along the curve. Probability-weighted decision-making, plus a consistent trading process. That is called edge. And that, one simple thing, is what makes great traders great. Remember, no edge, no bet. Small edge, small bet. Big edge, big bet. And I have 4 minutes left, and I'm going to run through 10 best practices. These are things, when I look at my experience working with top performers, mistakes they've made, what makes them great, what do they have in common? These are the 10 things I want to walk through and show you. Up, down, sideways. They have the mentality of keeping it simple. Before the open, ask yourself, is today to make money, limit losses, or do nothing? Doesn't matter if you need to make money, or if you're in a hole, or you're up money, you have to ask yourself the question, is the market going to pay me today for my positions? And then trade it that way. Because where you get messed up is when you have your own agenda going into it, and the market, it's one of those days that the market's just not paying. And you fight it, and you fight it, and you fight it. Before you put a trade on, write down your game plan. Your why. Why are you in this trade? What's your entry levels? What's your level of conviction? Does your size match your conviction level? What levels are you going to add? What levels are you going to take off? Have that established ahead of time. Everything I'm talking about here is outlined in the book. I think this is actually page 14 or 15, where I talk about the process of how to think about these things. And what happens is oftentimes you get a mismatch. You'll have A conviction and C size. Or you'll have C conviction and A size because you're getting desperate and emotional. A conviction, A size, B conviction, B size, C conviction, C size. Making money is easy. Did you know that? Did you guys know that? I'm not being flip when I say that. Why do I say it's easy? What's 45 to 55% again? Remember that number? What was that number representing? Average winning percentage of all traders. So you're going to make money half the time. You already make money. You want to have an interesting exercise? Break down your trades to how much you make and how much you lose. Make 2 separate columns. What you'll find out is that there are probably 3 or 4 trades, maybe it's 3 or 4 trades a month, maybe it's 3 or 4 trades a year, that you give back a ton of profits on. It's that one trade, and if you look at it and you're honest about it, you'll say, you know what, I knew I should have gotten out of that trade, and I could have cut the loss in half, but you didn't. You got emotional, added to it, held on to it. For whatever reason, you lost your discipline. Making money is not the hard part. Keeping is actually the hard part. H plus W plus P equals E. That could be the most important thing you ever tell yourself as a trader. Anytime you are hoping, wishing, or praying, you need to exit the trade. Push the button, start to get out. I don't care if you get out of 10%, 50%, all of it. Live to fight another day. H plus W plus P equals E. Hoping, wishing, praying, start to exit the trade. You make dozens of trades a year, hundreds of trades a year, thousands of trades a year. Your performance is not going to be judged on one trade. Look at your positions as if they're not your positions. Elevate yourself from the positions. Look at it like, anybody here a parent? I have 3 kids, right? I try to look at their lives from a different lens. I try to see it not as the parent of this one where it's like, oh, I can't believe he did that, and now I'm like very upset because of my own biases and agenda. I'm trying to think of it more objectively. Elevate yourself, just like your trading book. Elevate yourself mentally and look at it as if these were not your positions, as if it's not your P&L. If I had no positions on right now, what would I do? That should be your mantra. Anybody here meditate? That should be what you meditate to. If I had no positions on right now, what would I do? Train yourself to view your portfolio more objectively. Avoid tangifying. That word actually doesn't exist, but it fits pretty well. Tangifying is the act of turning P&L into stuff. That's why I asked you before. Do you think in terms of dollars or pounds as opposed to percentages and basis points? On the trading floors, we talked in terms of ticks. I made 10 ticks, lost 5 ticks. Yeah, I knew a tick was $12.50, but that wasn't the point. Still to do the math. It's one step further away from I just lost, 4,000 pounds. Oh my God. Because then you start to equate with what that actually physically is in the real world, as opposed to its percentage. I'm up 1%, down 0.5%, basis points. That's the mentality. What'll happen is the numbers get too big. Psychologically, it becomes crippling. I've seen this happen with clients, and that's why I have them convert their P&Ls and not even stare at them. They don't even need to, you don't even know your P&L. Doesn't matter. Look at it once in the morning, once at night, you're good. You sit there and watch it during the day. How many times you look at your P&L? What a waste of time and emotional volatility. And you're living and dying with every single P&L tick. It's the same thing like you smoke cigarettes and say, you know what, I'm going to stop smoking. It's hard to do, I get that. But if you're really focused and determined to be your best, you have to have the discipline. Number 6, focus on the trade, not the money. It's the trade that you want to focus on. Take your daily P&L off the screen, cover it. Trust your process, because process leads to profits. The best part about being at Bloomberg right now is I don't know who in the IT department decided that red should be the negative number and blue or green should be the positive number. But here's what I did find out in working with people. What color are stop signs? What color are traffic lights when you have to stop? What color was when you're going to school and you got something wrong? What color pen was used? Red actually is a psychologically anxiety-provoking color. Change the color to purple. Purple's a pretty color. And your pants are nice. They're nice red pants. But in general, the concept here I want you to think about is make it easier for yourself. You can actually change the colors on the screen. The default happens to be red, but you can change the colors. And if you can't, and you don't use Bloomberg, figure it out. Or maybe switch to Bloomberg and say, I want to use them because I can switch from the red to the purple. Purple's a much better color. And by the way, do you have a shorter position? So you're short a position, the market's down, it's flashing, flashing, flashing. Now you're getting the signal inside of anxiety, yet you're making money. That's called a mixed message. Make probability-weighted decisions. Use probabilities to figure out when you have an edge and to help you determine the proper size of your trade. Remember the coin game Ed showed us? Probability of winning times the upside minus the probability of losing minus the downside. Ed, if you had a 99% chance to win a game, would you play that game? There you go, baby. There you go. Happy to give you my money to trade any day of the week, Ed. I'm just kidding. But conceptually, yes, I would. He's thinking like a trader. And you saw it happen. You saw it happen. Now he's thinking like a trader. Market does not know your positions or your P&L. The market doesn't owe you anything. And the market's not out to get you. Yes, it feels like that, but that's not the case. And number 10, and most importantly, keep a trading journal. Does anybody keep a trading journal? One person, 2 people, 3 people, 4 people. There's got to be 125 people in this room. 125 hands should be going up. And if you don't before, now you do. And if you say to me, well, I don't know where to start, yeah, page 55, 56, 57, there's a template in that book that'll get you started. I don't care if it's a journal about your thoughts and emotions. I don't care if it's a journal that's more systematic. Keep a journal. Every single great trader I've ever worked with kept a trading journal. And I want to close on this. Final takeaway. No edge, no bet. Small edge, small bet, big edge, big bet. Thank you all very much for your time today.
And thank you so much to Dr. Doug. Can I please have you to yell at me and motivate me at 3 or 4 a.m. when I wake up every morning?
Yes,
I mean, that would be for work.
Yeah, that would work, because that's like, what was that, 5 hours earlier on my time.
Fantastic. I'm never going to see a pound coin in the same way again. Did that guy, someone hasn't taken their money back? Okay. Doug's got money to lose. All right. Oh, and that man or woman who's willing to spend up to £600 on dinner, come see me later, yeah? Okay. So thank you so much to Dr. Doug. And now I would like to move on to our next guest. He is Sujit Nagda. He's an equity derivative application specialist for Bloomberg, focusing on the UK and emerging markets. Please welcome Sujit to the stage.
Good evening, everyone. That was quite an insightful keynote speech. What I'm going to do next is take a bit of a tangent. I'm going to show you some relevant charts related to some of the most liquid futures globally. And I'm going to try to offer you some insights on what these charts are telling us, but also what I'm going to show you is how you can leverage off the capabilities of the Bloomberg terminal to offer actionable insights in your trading and investing activities. So before I start off, I'd like to thank my colleague Kevin, who's up there somewhere and who's going to help me with the Bloomberg screens. So firstly, I just wanted to touch upon something called Market Live. Now, Market Live is part of Bloomberg's First Word news service. And what that is that it is a real-time editorial insight that is offered in a blog style, bullet points, often accompanied with very powerful charts, which can really offer pretty cool insights into what's happening globally across assets, across regions. And I just wanted to pull up one chart just to show you how this can be of great help in trading activity. And this chart is a chart of the net bullish bets on crude oil. And you can see that there's been a sharp decline over the last couple of months in the net bullish bets. And the idea here is that if you look at the top left corner of the screen, you notice that there is an index on Bloomberg, a ticker on Bloomberg, that actually captures this particular piece of data and offers a historic time series on this particular series of data. And we have thousands and thousands of such indices, such tickers, that capture economic data, macroeconomic data, key indicators across assets, volatility, and so on and so forth, that can really offer ideas graphically often and visually to assist in your trading activities. So moving on to the next chart, this is, of course, one of the most popular in liquid futures globally, listed on the CME, the S&P 500 E-mini futures. Now, obviously, we noticed that there was a sharp crash in February, and since then, there's been both sides of news flow, good and bad, and the markets have remained range-bound. Now, there's numerous ways to look at this chart, of course, fundamentally and technically, statistically. But what I want to show you is how you can overlay several studies, several technical studies or indicators on charts within a few clicks in Bloomberg. Now, we currently offer over 300 such studies, but the one I've pulled up here is called the Bollinger Bands, which I'm sure many of you are familiar with. And what this study does is something extremely elegant and simple. it shows you a moving average of whatever the future or the asset you're plotting. And in this case, I've selected the 20-day moving average. And then it shows you two bands. The upper band is 2 standard deviations above the moving average, and the lower band is 2 standard deviations below that moving average. All of this is completely customizable. And you notice that despite being such a simple and elegant study, it really tends to capture the highs and lows pretty well. And it does seem to suggest that the market is about 2 standard deviations above its moving average right now. Now, what happens next? Who knows, you know? But this does seem to offer a very powerful optical idea or optical view into what the price action of that security has been. And the reason I say this is very relevant is whether it's humans or algorithms trading these futures, what they're all looking for is a divergence. A divergence from the momentum, a divergence from the long-term average, a divergence from the mean. It's just different sophisticated ways of looking at divergence. And this, fundamentally, standard deviations and means are what captures that in the simplest of manners. So the next chart, please, Kevin, is the NASDAQ 100 futures. And in this case, what I want to highlight is, if you look at the top left corner, the ticker is the NQ1 index. Now, what we've done on Bloomberg is that we realized that most futures are only active for the front month, either the monthly expiry or the quarterly triple witching expiry. And so what you notice is that those futures really trade only for that month or those 3 months. So what we've done on Bloomberg is we've created generic tickers, such as the NQ1. And that means this is the generic first expiry of the NASDAQ, which means you can then have the data series for a much longer period of time, often decades, if not years and years. And this, again, is the NASDAQ generic ticker plotted using a candlestick chart, not just the line chart, but a candlestick chart, which often gives you more insights into the highs and lows and gaps, which can be quite relevant for many of you. And this, again, is the Bollinger Bands plotted on the NASDAQ futures. Once again, the NASDAQ has obviously outperformed most global equity indices, naturally because of the technology stocks which continue to outperform. If you ask me what that really tells us, I would say fundamentally that's telling us that as a species now, we're valuing our virtual lives, our digital identities more than our real lives. But of course, that's open to interpretation. But this, despite the fact that this has been one of the most outperforming indices, the technical charts also suggest that this is about 2 standard deviations above its moving average, although there has been a slight retracement having hit that divergence. The next chart is, again, one of the most popular futures these days, and these are the currency futures, in this case, the euro-dollar future. The reasons for the popularity of these futures are obvious. They offer leverage. They offer a very high amount of liquidity. And it's often only very, very sophisticated institutions that can actually trade the spot currency. And so these futures offer access to a lot of other investors. Now, you notice that on this chart, what we've done is that we have a little button right at the top of the charts, which lets you select the key events for any given security. And by clicking on that little button, these little indicators come up, which highlight what are the key events that have caused a particular price action, a correction or a rally or whatever it was. And you can hover your mouse on any of those key events on that particular future or that particular asset, and you get a little summary of what really happened. Was it an economic data? Was it some other kind of news release? Was it the exchange? Was it the commercial bank's rate decisions, etc.? And there's also another button, the news button. And if you click on that button and hold your mouse at any point on that security, you get a little pop-up which explains what were the key news, what were the most read or most clicked news items that led to that price action. And in this case, of course, it's the euro-dollar future that we're looking at. And obviously, this was the Italian elections and the uncertainty around those elections and the coalition government that led to that sharp price action. So these are the 2 things that I wanted to highlight, the key events and the news, which really offers a way to investors to leverage the power of the entire Bloomberg offering, including the news, on any given security. The next chart, please, Kevin, is the 10-year Treasury futures. As most of you are quite well aware, the 10-year bonds have been selling off quite aggressively, which is obviously reflected in the future. This has led to something very interesting, which is that the 10-year yield has hit a 7-year high recently. We hit about 3.2%. We're still hovering at about 3%. But the idea that I want to emphasize here is that often these futures or these securities are not traded or too relevant in isolation. Investors often want to look at them in relative value, in comparison to another security. And the next chart that I've pulled up is a function on Bloomberg called HS, historic spread. And I've created a spread here of two commodities, or two futures rather. One is the 10-year Treasury, and the other is the 2-year Treasury, which are often traded correspondingly, which are often traded as a pair. And what we have on the right-hand panel is actually a statistical analysis of the spread between these two. Now you notice that the spread currently trades very close to the mean. It's in the 63rd percentile, not too far from the mean and the median for that matter. But you notice that there have often been divergences, and these divergences are what can be played very easily by futures traders as a pair trade. The next example is similar. I've pulled up the example of the silver futures that trade on the COMEX. Now silver is one of the commodities that has held pretty steady in recent times. But if I now run a historic spread of futures on silver versus the futures on gold, then we notice something interesting. We notice that the spread or the relationship between these two futures has offered some very interesting trading opportunities in the recent past. We notice that gold has been selling off. The orange line, which represents the gold future, has been selling off due to many reasons. The most prominent reason is probably the rise in yields, which makes gold less attractive versus bonds. But silver has held steady. And so looking at that relationship statistically and historically in this manner can offer actionable insights in trading these different futures. The next one is very interesting, very topical. This is the volatility futures. And the first chart that I've pulled up is the VIX futures. Now this obviously gives us a very, very solid barometer of market risk and market sentiment. And of course, in Feb, there was a very sharp and dramatic rise in the VIX, in the volatility, due to the sell-off in the markets. This has started correcting, but we're still far away from the lows that we saw last summer. We're still a good 5 or 6 or 7 volatility points away from the lows of last summer. The next chart is a regression analysis on the volatility across the Atlantic. So I've pulled up the volatility future for the VIX in the United States versus the volatility represented by the VSTOXX, or the VSTOXX future, which represents the volatility in Europe. And you notice on the right-hand panel that they have a very high correlation. The R is about 82, right? So they are highly correlated. But yet, if you look at the dispersion plot and the regression line, there are points that are significantly deviated from the regression line. And these are the points where volatility across the Atlantic has diverged significantly, statistically speaking. And the futures on these volatilities offer investors a very easy way to exploit that divergence, buying one future versus selling others based on this kind of technical analysis. The next chart is again extremely relevant for futures traders. What this chart does is that this is a function on Bloomberg called CCRV, or curve analysis. Now what this tells investors is that it shows you the term structure of a future. So any given asset would have futures for different expiries, 1 month, 3 months, 6 months, 18 months, so on and so forth. And the relationship of the price across those different terms offers investors a very good idea of what market sentiment is. Now these are the different time stamps, or these are the term structures of the VIX future at different times across the last 5 or 6 months. And you notice that at some times the curve is very steep, in which case the short-term volatility is low. But at some times the curve is very flat, in which case the short-term volatility or market risk sentiment is very high. But if I now just run that chart, including a curve for the sell-off in February, then you notice the white line is inverted. The futures actually went into what is called a contango, which means that the short-term future went significantly above the mid and the long-term ones. Or in other words, in this case, the short-term volatility was being priced significantly above the mid or the long-term volatility. But that curve immediately reverted back to the normal term structure, as you can see from the other lines. And that again, and this chart therefore again offers investors a very good way to analyze the market sentiment for a future based on the price of the future across different expiries. So lastly, the very notorious chart of the Bitcoin futures. Now, you notice there is a big gap. Now, why traders really like the candlestick charts is that you can look at the gaps. For an asset that's as volatile as a cryptocurrency, looking at gaps becomes very relevant from a technical perspective. But what I really wanted to show with this chart is that on Bloomberg, we not only have the price of any future or any asset for that matter, but we also have a lot of second-order data, such as the historic volatility of that asset. So if I run the next chart, which is a function called HVG, Historic Volatility Graph, then this is capturing the actual volatility of the Bitcoin dollar currency pair. And this is something very important for futures traders because when you are entering a future, you want to know what is the volatility of that underlying asset. And despite all the news flow and all these sharp moves, we noticed that the volatility of Bitcoin has actually come off in recent months. It was actually very, very highly volatile as far back as June 2016, but that volatility has actually significantly come off. So that's my talk there. I'm going to be hanging around after this session, and I look forward to interacting with some of you. We have several other functions for those who are interested. Futures calculators, which can help you generate the fair value of a future based on your own inputs. Options monitors, which also offer insights into the options market connected to the future or any other underlying. And so I look forward to interacting with some of you at the end of this talk. Thank you very much.
Thank you so much, Sujit from Bloomberg. I have to say some of those charts were quite familiar. I definitely use them in my reporting and anchoring during the day. So yeah, definitely if you have a Bloomberg, take a look at those. And we've got chart libraries as well that you can go through, download the charts. I feel like I'm doing the promo on TV that I was doing this morning. But anyway, we've now come to the part of the evening where we've got a great panel lined up for you. I'm really excited to introduce our panelists to the stage. So can I call up Eddie Toftbig, Head of Technical Analysis and Senior Market Analyst at ADM Investor Services International. We've also got Alex Haywood, co-founder and head of strategy at Axia Futures. And last but not least, Will DeLucy, managing director at Amplify Trading. Guys, great to see you all. I've seen a couple of you taking assiduous notes during the presentations, particularly Dr. Doug. So really looking forward to hearing all your insights. Eddie, I want to start with you. Not that I want to put you on the spot or anything, but you've been in the game for more than 30 years now. Yeah. Now, I haven't generally thought of day traders or more long-term traders as introspective people, but today I'm getting the sense that actually a bit of introspection can go a long way. So given that you've been doing this for such a long time, Eddie, what do you think it is about you that's meant you're still succeeding 3 decades on?
I think it's the hard work. It's being able to always realise that it's hard work and being able to embrace that hard work and say, I enjoy this. I heard a long time ago that if you work really, really hard, you'll get rich and you might make a bit of money as well. And that's the way I feel about it. There is a richness in what I do and what I have done that has been its reward, and not necessarily always monetary. But it's a great, great industry and a great thing to be involved in.
What time do you get up in the morning?
About 3:15, 3:30.
I thought I was the only one.
No.
All right. I want to turn to you, Alex, just to get a bit of a flavour, because what's great about these 3 guys is they all approach futures trading from quite a different perspective. So, Eddie, you work a lot with the technicals, obviously, and we'll come on to that in a second. But, Alex, I want to hear more about how you and your firm traded the event risk of the Italian election.
Yeah, thank you. Yeah, so we're a proprietary trading team based out in London, and a little office in Poland, and a small little satellite in Cyprus. And our entire approach when we're trading the Italian election, and we're day traders, is we take highly leveraged positions. We're very involved in harvesting, volatility, and that's and how to cultivate that edge. Now, for us, the edge, just a great talk by Doug, but for me, a lot of the time, that 5%. It can be as little as 5% mental, because if you don't have that skill, if you don't have that edge, it doesn't matter how hard or diligently you've worked, you can't extract money from the profits if you aren't able to recognize those patterns. So with the Italian elections, we noticed a really large volatility climax starting to happening, days, a couple of weeks ago.
And Alex, sorry to jump in, but we actually have a chart that demonstrates, Can we get Alex's chart up, Kevin, exactly what you were doing? Sorry.
Yeah, so for us, in the firm, we don't actually train people to have views, because views don't make you money. And what we do train people is to really focus on patterns that we've cultivated as a firm, or of how we harvest. So over here in the Italian elections, what we're actually noticing is, if you can see just further on down around about 2 weeks ago, where you see the white line and you see the orange line start diverging, and you actually effectively get a heightened negative correlation. Now, we don't trade these opportunities, and we actually trade on what's called a DOM, a price ladder. And we look for these, and that's for our timing. And so when the Italian elections, when the BTPs, which are the Italian 10-year bonds, and the 2-year bond, the BTS, was starting to create the systemic event throughout the asset classes, was how we're going to get involved in the bond market, because the liquidity in the market of the BTPs completely disappeared overnight. So from our perspective is, what type of order flow? So they mentioned earlier on, and CME mentioned that the technology is becoming more readily available for the retail trader. And in the past, you needed to have large technical infrastructure, and now you can actually trade on what's called the order book. And it's actually seeing the participants in the market exchanging. It's equivalent to watching the old days, the pit where the people are auctioning, and they're in the open outcry pit, and that's what you can actually see on what's called the price ladder. So on that day, when their liquidity completely disappeared, it was a Monday, Tuesday, Wednesday, the BTSs in the futures market, was literally on the order book. There were 1 to 2 lots, as opposed to on average 200 to 300 lots. So how do you hedge that, and or how do you speculate it from a profit perspective? And what we are doing is participating mainly in the German bond market, because there's still liquidity there as they were hedging in that space. But it's all well having that view. Is how do you observe the patterns to extract the opportunity? And what we do is, on that day when the BTPs made their absolute low, the current low, you always get, and we had it on the Brexit, we had it on the Trump, and it's just a little order flow event that we look at as a firm, where you get the final crescendo of the volatility of the move, and you'd get these large, abnormally large orders, 3,000, 4,000 lot. Some of you might not mean that much, but this is 6 to 10 times the normal size. And whenever we see that, we know that there's a potential reversal in play. And so we started getting long on the BTPs and BTS because of that order flow event. So that just describes it in a long-winded way.
Yeah, and you can kind of see how you can benefit when there's high volatility. But until the big market sell-off we saw in February, actually volatility was suppressed for quite a while. Is that a problem? And if it is, how do you work around that, Will?
Well, I mean, not trading, as I think Dr. Doug said, is one of the hardest things to learn. When there's a lack of volatility, it really is about being incredibly selective and disciplined. Because one of the problems in the low volatility market is, if you do end up trading just because you're bored or just because you're in front of the screens, it feels like an eternity before another opportunity comes. One of the things I wanted to talk about to you guys about trading futures specifically was the idea that we have a room here of traders who are moving away from the retail space into much more professional remit, whereby they have access to futures, to derivatives, they've got the live news feeds, they have a multi-screen setup, which also means they have many, many, many reasons to always trade. In the CME in your bags, you've got a toolbook, which lots of really cool, sexy things to do. You can apply them all to your charts and find any type of reason to trade. And I think one of the biggest challenges then, if you guys are going to move on to futures, there's huge advantages, as we've discussed, but one of the biggest challenges is the behavioral elements then when you're accessing futures, the price ladders, all of the movements and the volatility is it becomes much more accentuated. I just have a chart here to try and almost show what not to do. This is an example of a trader moving to futures for the first time, getting their playbook right, just as Dr. Douglas mentioned, on the left-hand side of the screen, top left, you can see they're trading the euro versus the dollar, the blue arrow buying, red arrow selling. They're following a strategy of just trading the range, nothing too complicated, nothing too exciting. And then they keep their discipline until 1:30 when non-farm payrolls comes out. This is the euro versus the dollar. So everything so far going according to the plan. What's quite disconcerting is that we see this sort of behavior in new traders that move to futures, but also, I fully believe that if you're doing this for a living, you deserve everything that you ever make because of the sheer behavioral effort it takes to remain disciplined. Because what you can see here is non-farm payrolls comes out, the dollar strengthens, so the euro moves lower. The trader goes short, gets stopped out, feels frustrated, so waits all of about 5 minutes before going short again, getting stopped out. And then, I don't know if you've read the book, I think it's Steve Davies, the Chimp Paradox, or Steve Peters, sorry, the Chimp Paradox, whereby this guy clearly after 2 trades inside his head moves to a cage, opens the cage door, grabs his 200-pound gorilla, sits the gorilla down, gives the gorilla the mouse, and lets loose. And you can see that just by a complete erratic trading. So when there's no volatility, one of the problems is the feeling that there won't be an opportunity. And it's that feeling you're looking at the screens and you just don't know where the next opportunity is coming from. Equally, when there is volatility, as shown in this example, it's all very well knowing what you should do, as Dr. Doug was saying, a strategy, a playbook, discipline. It's just, I believe that when you move to futures, you probably do need to get burnt a few times and go through that process to learn the hard way about discipline, not to act in this way.
Yeah, and Eddie, on that point, how much should you focus on the past in terms of learning from it for your next trade? Or how do you balance that with actually letting go of the past and just focusing on what's in front of you?
I think with all forms, and this is talking from the technical analysis, you look at historically what's happened in the past and try to apply those lessons in the future.
Right.
Not all markets are the same, but there are plenty of things that you can actually use and say, this will apply in the future. There's a likelihood this will happen. It will probably move in this direction, or this sort of action will happen. If you just concentrate on the single thing that you're actually at this particular point in time, then you're going to go nowhere, I don't think, really.
Alex, would you agree with that?
Yeah, I mean, the entire pattern landscape and how to determine of where you're extracting opportunity is a function. You mentioned earlier on of the hard work, but it's a large function of how you go in your questioning framework and your methodology of what opportunity is. And what I see in the retail market, what I see in the space with regards to the news that we get bombarded with is the ability to pick up skill sets to extract that edge. And when you pick up that skill set is, you find that people actually have that strong positive mental ability because they know the probability of success is high. Whereas I have traders on the floor, young traders who work incredibly hard, who do a lot of effort and a lot of work and draw these great big playbooks, but amongst all of that, they don't have that little edge that can really extract. You give a trader a little edge, he has that positive aspect. So the hardest thing is actually developing the skill set or the questioning methodology to find those edges in the market and those patterns that are repeatable but yet dynamic, because the market does change and shift, but whilst remaining the same.
Mm-hmm. Will, the word edge has come up a lot through this entire evening. What do you think gives a good trader an edge?
2 words for me, it's self-awareness. It's understanding what is being purely honest with yourself as to why you've made that decision, why you've entered into that trade, or why you want to be in a trade. And I think one of the things about technical analysis, for example, it's excellent in terms of finding an edge in many ways, but in other ways we see people, when they first move to futures markets, using technical analysis to justify their bias very often and just tweaking levels and tweaking lines. And that can come from a lack of self-awareness in terms of really understand. I think that the edge is really having gone to the darkest, deepest places in terms of feeling lost and lonely and without any type of control, and then recovering from that so you can recognize it again. And I think that's quite important. I can never tell a good trader when they haven't had a bad day. I can't tell a good trader if they've only traded well, because I really need to see how they recover, how they're resilient when they go through a period of time when everything they do doesn't quite seem to work. How they recover from that, to me, is the core of what makes a successful trader.
Okay. Since we mentioned technical analysis, Eddie, why don't you talk us through your chart and what you find compelling about it or what we can learn from it?
Well, one of the things when we first spoke was I was going to bring the S&P futures because I thought probably everybody here would know that. But I thought everybody else would mention it as well. So I thought, shall we try, would you like something esoteric? And I went, yeah, okay. So we'll do Kansas City wheat. This is on the CME, and this is a beautiful chart. This is beautiful. This is elegant. We've spoken about it as well. This is an elegant, beautiful chart. It has a number of features in it which are specific to what's happened over the last few months. Most of you are familiar with moving averages. And you can see that that's actually been underlying moving the market higher. But they're all lagging indicators. They're things that are behind the market. They're not contemporary at this particular point in time. Much as well as Fibonacci levels, which are, everybody knows where they are. That particular trident you can see there is actually a pitchfork. It's called in reality, it's a modified shift pitchfork. Now, I'm not going to go into the history behind it, but that's available on your Bloomberg. The Andrews pitchfork and a modified shift pitchfork can be drawn on it as well. And that gives you the angle of attack of the market, and it has done all this while. The middle time, line through the center of it, has actually been so accurate at pointing it which way it's going. So I can see which way it's going until it stops going. I can see where the top end of it is. There's resistance when it goes too far away from it. There's going to be pressure to push it down. And I can see when it's going to go too low, well, there's going to be buying pressure coming in. And I'll use other things on it, candlestick theory and various other things. And again, talking about behavior analysis, one of the things, and something we spoke about as well, was the very first modern book on economics, probably, I think most of you would say, is Adam Smith's Wealth of Nations, 1775. In Japan, in 1750, Maneshi Homa compiled 3 books, and he compiled them. They were already knowledge that was already in the market. And that's what we use for candlestick theory now. In one of those rules that he had was, if you lose money, step away from the market for 30 days. Now, can I see any of you walking away from the market for 30 days? I don't think so. So we have to adapt it to modern times. Finesse and optimization, I see what you mean about people optimize things. They want to read what they want to see in it. They're not looking at what actually is the picture there and saying, that's what's actually happening. Then, as Dr. Doug said, then I'll make my decisions. This is just part of what you need to do.
I want to talk about sort of looking at the future direction of the markets and making predictions, whether it's based on history or whether it's based on what's in front of you. It's not that I want to call you up on this, Alex, but we were talking outside just before we came in, and you were saying that on Monday, when the BTP futures opened, actually some of your traders were kind of caught by surprise by what the market was actually doing, because they hadn't expected them to react in the way that they had to the Italian finance minister's comments over the weekend saying that actually leaving the euro wasn't under discussion. And even I'm approaching this as a financial journalist, when the cash market opened at 7 a.m. and I saw the 10-year yield on the BTP drop more than 20 basis points, I was like, what's going on? So actually, can you always, well, obviously you can't because people get caught short sometimes, but how do you distinguish between those moments where you can actually predict and those where you can't?
Yeah, I mean, the game or the art of speculation is having that, artillery or the ammunition of strategies to deploy into the market, like any great, war general. And, for example, what happened to a broad-based, our London team on Monday morning was a result. I mean, you get the news firing in, and we knew before, the hindsight analysis, we knew already on the weekend that, there was not strong Italian news of them leaving the euro. But there was all the calls, and we have various plays that we play on the open. When the futures markets open at 7 a.m. UK time, we put on these relative R plays across the various government bond curves in Europe, and they're all, there are a few that are out of line. But one of the things that the traders never considered was the liquidity risk. It just required one trader on the planet that maybe needed 500 lots, and he needed to offload them on Monday morning in the BTPs. And so participating in a market, it's a lesson I learned when I dropped my entire account about 7, 8 years ago on the Shats on an ECB when there was no liquidity. And that was one of my first little affirmations and mantra, don't participate in a market when there's no liquidity on the order book. So Monday morning came, and one of our traders who's had a phenomenal run, had his confidence, just edging forward, and the news came, and we knew about the news, and the news obviously gained more weighting in the media after the movement, and that's what always, traders get really irritated with the news afterwards. They always say, yes, so that wasn't important 5 minutes ago, but now it's important because they've had the justified move. And so yeah, so we lost we lost a bunch of money, but the learning from that is don't participate. The bonds you could have still participated, but why trading? Why trade a market or expose yourself when the liquidity risk is heavy? And we've all repeated that mistake, but it's the learning you take from that. The next time you're faced with that same scenario, how you engineer yourself or how you navigate yourself around that opportunity. And the nature, the greatest traders are the ones to take the learning and then push forward when they recognize that pattern and event again. They've consciously recorded it into their unconscious state, and they're able to extract and take advantage for the next time.
And I guess Doug was talking about journaling earlier, and I know, Will, that you're a big proponent as well of kind of keeping track immediately after events have occurred of why traders did what they did.
Well, just interesting listening to Alex when you mentioned about the liquidity in the Shats. For me, I had the same. I think it was in 2008 when oil popped $30 at about 8:30 p.m. to 9 p.m. It was the biggest ever intraday move. And I got hurt on that move. And what was interesting is that as you get more experience, if you are able, these sort of experiences don't leave you. You can probably remember minute by minute what happened on that Shats trade. I can remember on the oil trade. And what happens as you get more experience is then you recognize it as another one of those. This again, I've seen this happen, this is what I did last time, and this is what I won't do this time. And in that case, I think those sort of experiences, so learning a liquidity lesson, if you can survive them, they are worth the money that you lose. But interestingly, some of your research showed, Bloomberg's research showed a couple of months ago, that...
You guys are all bigging up Bloomberg like crazy.
Over 50% of asset managers have less than 9 years experience. Now, why that scares me so much for the industry is because it's 9 years since we've had a major market correction. If you've been working in derivatives and trading for the last 9 years and all you've ever seen is relatively low volatility comparative to 2007, 2008, if all you've ever seen is when equity markets move lower, central banks come in and hold the baby and actually everything's fine. It doesn't matter about Greece, Italy, Korea. It doesn't matter about a proxy war in Syria because actually markets are consistently stable, which is really what we're seeing apart from a wobble in the beginning of February, then my concern is that if we do get one of these big corrections, there aren't enough experienced people that can recognize it as this is another one of those. And they're going to have to learn that lesson for the first time, which is what is rather worrying in my opinion.
And is this all compounded, Eddie, specifically when it comes to futures and other derivatives, perhaps because of leverage?
I don't think necessarily leverage. I think what it's actually, there's a number of factors that have caused this. I think the electronic markets have helped in that particular sense. We were talking about situations, I mean, I just went through the whole list of ones I could immediately remember, which was first off the Euro Swiss. I don't know if any of you were involved in any of that one. When that sort of, that was a market not fit for purpose. There was actually no trading. There was no bids and offers in Euro Swiss at one point. Then you've got...
January the 15th, 2015.
Yeah.
I remember it very well.
You've got the ERM crisis. I remember the Irish punt, which it was then. overnight interest, and it was nothing to do with Ireland. Overnight interest rates were at 17,000%. You know, what? It's crazy. But those sort of things, the black swans or grey swans, more of those will happen, and the more will happen because we've got bigger markets, more participants, and it will come from somewhere. It may be Turkey this time. It may be coming from Argentina. It may be coming from anywhere else, and it will all come in somehow and affect us. It could be. There's some analysis that says the next crash will be in 2020 because of the 12, 13-year cycle that goes through. And it's actually 12 and a half, so it goes 12, 13, 12. So mid to late 2020 is the next crash is going to be happening. But whether it actually happens or not, there are signs beforehand. Before the Euro-Swiss, I noticed some of the retail brokers started raising their rates. And you didn't understand why. It's because they weren't comfortable with what was going on. No line in the sand is ever a line in the sand. If the one thing you need to know is central banks can't stop markets.
And just because you've got all this perspective and you've pointed to some sort of incidents in history as well, I mean, I ask this a lot on TV and radio to, you know, CIOs and to the sell side as well, in terms of whether it's more difficult to get returns in this environment. Is it from a trading perspective?
I think it is because you're getting less liquidity, less participants, the markets dry up. 2008 was an example where we had people not wishing to trade with each other, not wishing to, I mean, exchanges were fine, but the people were not wishing to trade with each other. And this is the OTC market, and that reflects, because a lot of liquidity in the futures market comes from the OTC market. So we didn't have that. So yes, it stops people trading. It stops the lifeblood of it moving forward.
Alex, how important is it to have a real in-depth awareness of macro events, as well as being able to look at technical charts and being able to read the order book and that sort of thing?
Sorry, just to answer,
oh, yeah.
I mean, just to on the point that you just touched, we actually had, as a proprietary intraday trading, we actually had our greatest years in the financial crisis. We've now the traders at the moment having the best times of their career. It depends what edges you can extract in the market. So I suppose it depends where your so-called institutional funds and your larger funds who find it harder to navigate that type of liquidity around. They find it difficult to extract returns, but there are day traders who are still making exceptional amounts of money, and discretionary day traders, the ones who don't require an HFT system or or algorithmic, guys who are able to extract money. Your question was the macro.
How important is not just an awareness, but actually an in-depth knowledge of macro events to add to being able to do technical analysis, look at the order book, and sort of other approaches to trading as well?
Yeah. So one of our core skills where we trade a lot, we trade all the central bank decisions out of the main. The ECB, the Bank of England, the Bank of Japan, even the Bank of Canada, and sometimes the RBA and the Fed. So it's Fed and ECB, and these are
a big week this week.
Yeah. So these are our biggest days of the year, and a lot of retail traders look at it and say, well, you stay out of that. But for us, once you start building the narrative and understanding the narrative against the contextual background of the technical landscape, and then overlaying that with your order book, which is really showing you the auctioning nature of the market, is where we start designing our strategy. And a lot of times you'll have on an event or on a day, you'll have the ECB that actually raises the rates, but the market wasn't technically ready to move in that direction because someone's been absorbing. You've been watching this person absorbing on the ladder between 28s and 35s for the last 3 days. That's information, order flow information that you can use on your overarching macro narrative that you've built up. So for us, the macro environment with regards to geopolitical events and central banks, there are patterns on how the news is released, how the market digests the news, and once the market has digested the news, how you could have even bigger news hitting the market, but the market digests less because the market becomes tired of the news. So it's understanding that entire timeline of events and when the opportunity starts coming to the market and when it starts dying out. And the best traders who are trading macro events using their technical approach as well are the ones who are able to isolate the ability when the sensitivity of the news to the market starts becoming dry, or when it starts really, really pushing up. So yeah, it's one of the most advantageous and one of the most opportunistic events for us as intraday day traders using the DOM, which is direct market access to the CME and the various products.
You're nodding along, Will.
Yeah, absolutely. I mean, I think at Amplify we definitely look at fundamentals as core, but there's a twist, I think. I know, I'm very sorry.
It's using the F word.
But you're going to like
using the F word.
You're going to like my twist. My twist is we try and get our traders to take one step back and say, right, this is what the fundamentals mean. This is what they should mean. But have that to one side. You now need to know what other people believe about these fundamentals. So use Greece as an example. In 2015, all of our traders had to learn about Sampras, the Syriza party, the intricacies of Greek politics mattered because that moved markets. Now you could have quite a major event in Greece, fundamentally, but actually the market doesn't care. The market doesn't care because it doesn't care. Behaviorally, it's not looking at it. So there's two levels to this. Number one is definitely understand the fundamentals, put the effort in, put the hours in, and get a deep, hands-deep understanding. But on top of that, try and understand what the market actually cares about, because that might be very different to what the fundamentals should mean. So yeah, fundamentals very important, but we do find sometimes our traders have the biggest losses when they understand the fundamentals and then they're sure that they're right. So they've applied a strategy without actually trying to see, well, you might think that's important, but that was important in another time. This is a different type of market now. So yeah, fundamentals are important, but behavioral and technicals as well.
Sorry, Eddie, you keep shaking your head. Should we just F the fundamentals?
I can live with fundamentalists, but they can't seem to live with me. I try to understand their point of view. I try to live with them. I let them carry on with it. But yet they don't like when I turn around and say, no, it's doing that because of the technicals. Today, when I was leaving, somebody from my grains there said, oh, that market's gone up back above your line because there was a USDA report came out today, United States Department of Agriculture report came out, and it helped. And I was like, and what? What does that mean to me? Nothing. I don't care. I really don't care. The chart tells you where it is. Everything is in the price. We trade the price. We don't trade what the USDA does. Then you trade a USDA stock or something like that. You're trading the chart. You're trading what's there, the product that was there. If you're not trading that, then trade something else. But it's the actual price you're interested in. And everything starts with the price, then you look at open interest and volume perhaps, and then you apply the knowledge you've developed in technical analysis. And the problem, I agree with you on this, matches are a dangerous thing for children. Technical analysis in the hands of people sometimes is a tool which is like matches for children, or kids playing in traffic, or putting a blender on top of it and plugged in and leaving the room. You've got to learn. You've got to go through the societies that are appropriate, get qualifications, and learn about that sort of stuff, and then apply that.
But it doesn't have to be one or the other. I absolutely disagree. It doesn't have to be one or the other. In fact, I think it definitely shouldn't be just fundamentals, and it definitely shouldn't be just technical analysis.
I mean, can I just have one? I'm actually, most of our trading is technical, and but the ability of a successful trader is how to leverage in the right moment. So sometimes we will go into the ECB and we actually feel that the market or the euro wants to go up, and the ECB's come out dovish. And technically on that price chart, it's coming off in the knee jerk, but you can see there's someone sitting on the buy side. Yeah. And because of that, and you have this technical conviction on the upside, you have the fundamental that's showing the opposite to the technicals, and you use that, you leverage that fundamental to get aggressively long on the long side of the euro. So you're using that information to lean on your technical pattern, and then you're extracting opportunities. So sometimes using the fundamentals provides a lot of ammunition, a lot of fire to your leverage position to get that long, that euro USD, because someone was actually sitting there on the buy side.
I tend to think of it's more like the fog of war that you get rather than fire. It just sort of obscures the view. There is You can look at it, and I mean, I'm not saying get it right. I wouldn't be sitting here if I got it right all the time. I'd be out there on a beach somewhere. But what I'm saying is that this gives you an idea. It gives you the edge, which you're all looking for. All of them. All of us are looking for.
We've talked a lot about the benefits of futures, but Will, what are some of the risks that someone who perhaps doesn't trade futures very much or is thinking of adding them to their portfolio, what are some of the risks to be aware of so that you can make the most of those?
I mean, I think the biggest risk really is, as mentioned before, it sounds like a benefit, which it is. Obviously, they're cheap and easy to access, direct market access, no spreads. You've got all of the bells and whistles. And I think in a novice's hands, therefore, you can do yourself a huge amount of damage. And normally when people add futures to their portfolio, I think it's when they can really discover the addictiveness of doing this in this way. And it's when people are trying to do it for a living, to take it up to the next level, then they can fall into those behavioral traps that we've mentioned. Just because it's there, the ladders, the market depth, you can see all of these things that are trying to encourage you to please your vices. And I think the biggest risk with that then comes leverage and margin. Somebody puts margin in their account, what's the maximum size I can trade? And let's go for it. And I think that sort of attitude can do someone a lot of damage very fast. So, the best thing about them for me is just the flexibility, the ability to be adroit, fast and flexible and skillful, where you can size your risk accordingly, size out of trades as you get the opportunity to do so, the speed of access. But I think with that comes great responsibility. And it's all about trying to be involved in the futures markets for long enough to go through those bumps, to get hit a few times, so that in 2-3 years' time, when you're trading with much larger size, because the best thing about it is what you do with 300 contracts isn't actually that different to what you do with 30 contracts, liquidity permitting, in terms of behavior, psychology, strategy, the reason behind the trade. So leverage can be exponential in terms of returns, which is great. But then obviously with that comes a huge amount of danger if you're not ready for that size. So you don't have to trade your maximum size and your maximum leverage. And I don't think 30 days rest is too much of bad advice, actually. I wish some of our guys would do that sometimes.
I agree entirely with what you're saying. And I think it comes down to what we saw earlier on. Do you make a choice? Are you here for the hormonal buzz you're going to get from trading, or are you here to make money? And that's the first question you should ask yourself when you wake up in the morning. And is that what I'm going to do? If it's the hormonal buzz, leave the screen, go away, do something else. If you're there to actually start trading, then do it properly.
Is the risk return the same across asset classes? And how should you approach the various asset classes? Should you just go with what your background is and then hedge using futures? Or how would you approach it from that perspective, Eddie?
I mean, some futures are different in their cash settled and some are deliverable. So you have to bear that in mind. But I would, for me as a chartist, I look at them all the same. Right. They may be that I actually look at something specifically and say, this doesn't apply. I can't use an Andrews pitchfork on this, or a shift pitchfork. I can't use Fibonacci on this because it's not really going. I looked at a cobalt contract on one of the other exchanges, and it went through the roof. So I was kept pushing further resistance levels are higher. You can't always use things on those. So you have to look and say, this applies for this, but not across all markets. But the rules for actually your money management, I'm sure they apply across all of them. It's not unreasonable to say that most people look for a return of 2 or 3 to 1, the risk-reward ratio. I think that's the very old way of looking at it. So that's a very early starting point and moving on from there.
Alex, for you, is it mostly about the liquidity?
Answers exactly the same. Liquidity is a very important consideration. And then how we apply, so we use the market profile, which I think is a CME charting tool, and which shows the time structure of the market. And the market profile for us, which shows us the contextual arrangement of the market, has just a different approach across different asset classes. And so how you apply that across the asset class is up to you. Now, just with regards to technical analysis, the main thing is sometimes from our perspective, the best traders on our floor have the cleanest charts. You know, they don't accessorize it with 100 different indicators and moving averages, because the markets, you know, as Doug mentioned, are rather simple. Well, simple from the perspective of going up, down, or sideways. Hard to, you know, to find your edge or the pattern that's consistent. And so from that perspective, you know, a very clean landscape, and then having the ability to understand yourself individually as a person. And every good trader should actually have his own patterns that he's never read in any book. You know, effectively, all the best patterns are the ones that you've manufactured with all the subtleties that you are able to extract from the market. So, so that's really important. You know, it's what we train all of our younger graduates is the ability to believe in yourself in uncovering the patterns of the market and how you perceive things, because we're all quite unique and different in how we perceive opportunity.
Wow. Will?
I think just two things that I'd advise anyone here looking to get into futures when it comes to asset classes. The first one is I don't think they're all the same in terms of how they move and how they're structured. You know, we've seen people who work really hard to grind money away in Schatzbubble-Bund, and then they touch the DAX for a day and give away weeks of work. You know, you've got to really understand the volatility and the personality of how these different assets move on the exchanges. And the second one I would say is try and not just stick to one or two faithfuls. I think what we also see when it comes to asset classes is somebody might always try and trade, maybe it's Euro-dollar futures, for example. And particularly then when they have a difficult time in that asset class, strangely enough, the one that they're struggling in, they trade more. Because then it becomes a personal vendetta. It becomes like a tie between you and that ladder that's got the negative P&L at the front. So when it comes to asset classes, if you feel like you're out of sync with one, you're not reading it correctly, just move on. Look at something else. So I think they are different, and don't be stubborn in sticking to just the ones you know.
We literally have 60 seconds left, so not to put you guys on the spot, but just a final word, a piece of advice for everyone in the room and everyone listening on the live stream. Eddie.
Join your local society of technical analysts.
Alex.
I think that was quick enough.
So do I have 90 seconds now?
Do whatever you want.
I think the most important is trusting yourself and having an ability, a questioning framework to ask yourself at the end of each trading session of you know, what you saw in the markets. And for us, what we do a lot is we ask the question is, where did the moves originate from? What did the context look like? And then slowly, the brain is incredible. You start putting the puzzles together. And over time, through that conscious, deliberate practice, you pick up the patterns of the market.
Yep, and for me, it's just self-awareness. Be honest with what you're feeling, and if you can recognize when the gorilla's going to sit at your computer, then just take a break, 30 days or less.
Fantastic. Thank you so much. Eddie Toftpick, Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International. Alex Haywood, Co-founder and Head of Strategy at Axia Futures. And Will DeLucy, Managing Director at Amplify Trading. And I think you're all sticking around. So if any of you, try not to swamp them, but if any of you want to talk to the guys afterwards, I'm sure they'll be more than happy to take your questions. Thank you so much.
Thank you.
Yeah, we can go. All right, well, that's it. So thank you all for coming. Thank you for being such a captive audience. Thank you for laughing at some of my lame jokes. You can all head out now. We've got drinks and canapes just outside. Feel free to stick around. I think we've got the space until about 8 p.m. Thank you. I forgot I had to, like...
attending, kind of thanking CME as a sponsor.
Okay.
And at that point, we're going to announce the winners of the freeze prize draw. To do so, you know, we're going to call William up, you know, to kind of say a few words and then to announce.
And then are you going to pick the numbers up? Yeah.
I think we're doing that behind the scenes. So when we're ready,
What happens if
winners,
not here?
we're going to keep calling until we find them.
All right. Kill the music.
And there's no free surprise draw, right?
Yeah.
Yes.
It should automatically go on platform control of that. It might just automatically.
Is that all good? Sorry, I threw you in the... Is the mic on, guys?
So maybe if we just gather everyone kind of in this direction towards the... Yeah, if you go stand over by the trophy, William, if you just want to go over by the trophy. Yeah?
Mic's on. Hi everyone, me again. Can I get your attention just for a second? I'd like to hand over to William Knottenbelt from CME Group. You really want to hear this because I know you were all entered, or most of you were entered into a raffle. So William is here to tell you more about that and to announce the winners.
Thank you very much. First of all, I'd like to thank everybody for joining us today. It's been a great session. I hope you've all enjoyed it and found it very interesting. The reason why we have this trophy here is because we sponsor Saracens. We have done for the last 5 years. And this is the 3rd Premiership trophy they've won, and they've also won 2 European Cups at the same time. And actually, talking about Doug and the sports psychologist, the one at Saracens and